Every year, federal retirees lose thousands of dollars to unnecessary taxes. Not because they invested poorly, not because the market collapsed, not because Congress passed a sudden tax increase. They lose money because retirement begins without a tax withdrawal strategy. In 2026, this mistake is more expensive than at any point in the past. Large traditional TSP balances, required minimum distributions approaching, Medicare premiums tied to income, Social Security taxation triggered by total income. When withdrawals are made without sequencing, taxes quietly become the largest lifetime expense. The biggest tax mistake federal retirees still make in 2026 is simple: retiring and withdrawing money without a coordinated plan for which dollars are used first, second, and later. Federal retirees typically enter retirement with a FERS pension, traditional TSP, often Roth TSP, future Social Security, sometimes taxable savings. Despite having multiple income sources, most retirees treat them as one bucket. Money is taken where it feels easiest, usually from traditional TSP. This creates a problem. Traditional TSP withdrawals are fully taxable. Stack those withdrawals on top of a pension and later Social Security, and taxable income escalates rapidly. Higher taxable income produces 3 immediate consequences: higher federal income taxes, more Social Security becoming taxable, higher Medicare premiums. These effects repeat annually. Once triggered, they rarely reverse. Consider a simple comparison. 2 federal retirees each need $75,000 per year. Retiree A, $75,000 entirely from traditional TSP. Retiree B, $45,000 from traditional TSP. $20,000 from Roth TSP, $10,000 from taxable savings. Both spend the same amount. Retiree A reports far more taxable income. Retiree A pays materially higher federal tax. Retiree A triggers higher Medicare premiums sooner. Retiree A loses more money every year. The difference is not investment returns. The difference is withdrawal structure. Many retirees assume taxes will naturally decline in retirement. For federal retirees, this assumption is frequently wrong. Reasons: pensions create a permanent income floor. Large traditional TSP balances generate forced distributions later. 2-income households remain common. Social Security adds another taxable layer. These factors keep taxable income elevated for decades. Without planning, taxes often rise over time rather than fall. Tax planning in retirement is not about avoiding taxes. It is about controlling when income is recognized. Control produces lower lifetime taxation. Lack of control produces permanent leakage. The most powerful control window occurs before Social Security begins. These years are commonly referred to as bridge years. Bridge years are the period between retirement and the start of Social Security. During bridge years, pension income exists. Social Security income does not. Total taxable income is often lower. Lower income creates planning opportunity. That opportunity should be used to withdraw from traditional TSP at lower tax brackets, perform partial Roth conversions, reshape future required minimum distributions. Failing to use bridge years allows large traditional balances to remain untouched. Those balances later generate large RMDs. Large RMDs force income into higher brackets. Planning early prevents this chain reaction. Another foundational principle is blended withdrawals. Instead of pulling income from only traditional TSP, an optimized retirement plan draws from traditional TSP, Roth TSP, taxable savings. Blending smooths taxable income. Smooth income reduces bracket jumps. Bracket jumps increase lifetime taxes. This concept is simple. Its impact is enormous. Example: retiree needs $6,000 per month. Option 1, $6,000 from traditional TSP. Option 2, $3,500 traditional TSP. $1,500 Roth TSP, $1,000 taxable savings. Option 2 reports significantly less taxable income. That difference repeats every month, every year, for decades. Bracket awareness is equally critical. Tax brackets are progressive. Each bracket has an upper boundary. Income above that boundary is taxed at higher rates. Effective retirement planning intentionally fills lower brackets and avoids spilling into higher ones unnecessarily. Without bracket monitoring, retirees routinely overfill higher brackets simply because withdrawals were not coordinated. Once paid, those taxes cannot be recovered. Another overlooked consequence is Medicare premium inflation. Medicare Part B and Part D premiums increase based on income. Higher taxable income causes retirees to pay thousands more per year for health care. Many retirees incorrectly believe these increases are unavoidable. In reality, they are often income-driven. Income is partially controllable. Control requires planning. Social Security taxation follows a similar pattern. Provisional income determines how much of Social Security becomes taxable. Unplanned TSP withdrawals increase provisional income. Higher provisional income increases Social Security taxation. Again, sequencing matters. A tax-efficient retirement plan integrates projected pension income, TSP balances by tax type, Social Security claiming strategy, expected future RMDs, target tax brackets. This allows controlled withdrawal, planned conversions, income smoothing, long-term tax reduction. Without this integration, retirees are guessing. Guessing is not planning. The practical takeaway is straightforward. Before retiring, federal employees should be able to answer: which account will fund the first years of retirement? How much traditional TSP will be withdrawn annually? Whether Roth conversions will be used? What tax bracket is being targeted? How future RMDs are being reduced? If these answers do not exist in writing, a tax strategy does not exist. The biggest tax mistake federal retirees still make in 2026 is retiring without a coordinated withdrawal sequence. Markets fluctuate. Tax damage compounds. Strategy determines outcome. Taxes will be one of the largest lifetime expenses in retirement. They should be treated with the same seriousness as investment allocation.